A viewer emailed me this week and he wanted to know, he said, Rob, cash is paying a pretty good yield right now. Should we sell our bonds that are in our portfolio and put that money in cash instead? And I think that's a great question. I've actually received several emails on it, so we're going to cover it in today's video. Now, I actually covered this topic over a year ago. Here's the video, and it was cash versus bonds in retirement. I'll link to that video below this one. That video covered it in a slightly different way, and it was a slightly different question than what we have today, but same basic concept, so I'll leave that for you if you haven't seen that video. But this is a really important question, and it brings up market timing questions, how we think about long-term investing, and it also raises the question, well, why are we getting more on cash today than bonds? So let's take a look. First, let's kind of look at the interest rates to see where things stand. So I'll start with savings accounts. This is my site. I'll leave a link to it, but you can see yields in the 4 to 5%. I think the highest yields on a savings account, you can see this one's 5.15. This one's 5.22. You've got some here a little higher than that. We'll call it 5+%. That's what savings accounts are paying, at least many of them. And if we go to bonds, well, you look at this at Fidelity's website. I want to look at this row right here, U.S. Treasuries, and you can see it's 3 months. So in other words, that's just a 3-month bond. You buy it now and it matures in 3 months, all the way out to 30 years, all the way out here. And if we follow the yields, they go from higher to lower for the most part. It starts at 5.36. That's the highest for 3 months. It goes down a bit each as you extend out a little bit longer. At the 2-year bonds at 4.77. If we go all the way out to the 30-year bond, it's 4.63. And looking at these numbers, and hopefully you can see them, but again, I'll leave a link to this below the video. When we look at these numbers, it makes sense. The questions you guys are emailing me, why in the world should I settle for a yield in the 4%? And why not just get a treasury bill or maybe a savings account or maybe a short-term certificate of deposit, like maybe a no penalty CD? They're paying above 5% as well. Isn't that the smart thing to do? I mean, it's just math, right? I mean, how hard can it be? And it turns out I actually think moving to cash would be, for many people, myself included, a mistake. And I want to kind of share why. Now, putting all of this in context, we can think of all of this as just fixed income. Everything we're talking about, whether we're talking about a U.S. government bond, let's say, or a savings account, it's all debt, right? We're a lender. We're lending money to somebody. Obviously, if we buy a U.S. government bond, we're lending money to the U.S. government. That's true whether we buy an individual T-bill, for example, through your favorite broker, or we do it through a mutual fund or ETF. We're investing in U.S. government bonds. We're a lender. The U.S. government is borrowing money from us and, of course, paying us interest in return for that. If we deposit money to a savings account, we're just lending money to a bank. We're still a lender. We don't call that a bond, but functionally, it's the same concept. Of course, if it's an FDIC-insured bank account, we get that government protection in the form of FDIC insurance up to the limits, and so we can think of all of these, FDIC-insured savings account or a U.S. government bond, as effectively risk-free, and I want to talk about what that means. When it comes to bonds, really any fixed income, there's basically two risks. One is called credit risk. That's just the risk that you're going to lend money to somebody or some entity, and they're going to go belly up. They're going to fail to make the interest payments or return the money when the bond becomes due, or if you deposited money at a bank, the concern is they go belly up and you go to get your money back and it's not there, right? So credit risk. Now, for our purposes today, we're going to by and large ignore credit risk because we're talking about savings and bonds all backed in one way or another by the U.S. government. Again, either through FDIC insurance or because it's a U.S. government bond. And that's about as risk-free as we can get. Where credit risk really plays into is if you're lending to, say, companies that are on shaky financial footing, or maybe you're lending money in an emerging market sort of bond fund where the risk of default's really significant. But in our case for today, Credit risk, we don't really need to worry about it. But what we do need to worry about is the second risk, and it's called interest rate risk. The idea is, imagine if you deposited money in a savings account paying 4%, and the next day the rates went up to 5%, and you called up and said, okay, I'm just making sure I got that higher rate, right? And they said, no, I'm sorry, you're locked in at 4% for a year. Well, we wouldn't be very happy with that. Of course, that's not how savings accounts work. If the interest rate on that savings account goes up, you immediately get the benefit of that. In that sense, we can think of a savings account as very similar to a bond that matures every single day. Every single day you can take your money out without penalty. Every single day the interest rate can change. So we can think of a savings account as a bond that matures every single day. Now, at the opposite extreme, imagine investing in a 30-year U.S. government bond that, say, pays 4%. In fact, we can actually look at the number. Today it pays about 4.63%. Imagine you buy that today, you're locked in for 30 years. Now you can sell it, we'll come to that, but you're locked in, so to speak. And if tomorrow the rates jumped to 6%, you wouldn't be very happy. And yes, you could sell the bond, but of course buyers would want a discount because they would be saying, why should I buy your bond that at 4.63% when I can get a brand new one at 6%? So you could sell it, but you'd have to take a big discount. So how does this relate to the question of cash versus bonds? Well, two ways. With cash, we want to think of cash as something that's risk-free, so again, backed by the U.S. government in some way, and that has a very short maturity. So again, you can think of a bank account, FDIC-insured bank account, like savings or maybe a money market account. You could also think of money market funds that you might get at Vanguard or Fidelity or Schwab that use U.S. government short-term bonds. Or, going back to the Fidelity website, we can think of, I think, Treasury bills, certainly on the short end, say 3-month Treasury bill. I would definitely view that as cash, even though theoretically there could be a little bit of interest rate risk if you bought it and the rates went up and you had to sell it before the 3 months was up. Still, I think pretty close to cash. Now, that gets us to the next question. Is it normal for interest rates to be higher on these shorter maturity bonds and lower on the longer ones? What's going on with that? I would think we would get higher rates if we were willing to take on that interest rate risk and invest in a 20 or 30-year bond. Well, your thinking is spot on. Normally, as the maturities get longer, the yields get higher. So normally, you would have a higher yield on, say, a 30-year U.S. government bond than you would a 10-year U.S. government bond or a 2-year U.S. government bond. The longer the maturity, the higher the yield. And that's the case, except when it's not. And there are times, like now, when you actually get a higher yield on, effectively, we'll call it cash, a 3-month Treasury bill. They call that an inverted yield curve. That's just fancy talk for things are upside down, and cash is earning a higher yield than a 10 or 20 or 30-year Treasury. And we can show you that graphically. Of course, we see the numbers here. They're obviously higher in the short end, but we can also go here. This is the Federal Reserve Bank of St. Louis. It's a bunch of economic data that they put out. And this is comparing the 10-year to the 2-year. So it's comparing effectively this yield right here on the 10-year and with the 2-year. Now, that's not the only way you can think of an inverted yield curve, but this is a common approach. Sometimes they get compared to the 3-month. In any event, what's the difference? And you can see, back in 2022, the yield curve was inverted. And all that means is the 2-year Treasury yielded more than the 10-year. So when you took the 10-year yield and you subtracted the 2-year yield, starting in about July, I guess, of 2022, you got a negative number because the 10-year yield was lower than the 2-year yield. And you can see it's been negative for a pretty long time now. We're talking 2 years. That's a fairly long time for an inverted yield curve. Sometimes it's been inverted more than others, like I'm pointing here. The difference was over 1% in March of 2023. It's, kind of gone up and down and bounced around, but it's been inverted now for quite some time. Now, normally, people will say that is an indication we're headed towards a recession. And that's certainly true. It's not a guarantee that we're heading towards a recession. And at least so far, right now, we've avoided a recession. but we'll see what happens. We can actually look at some of the data on that. And again, I'll link to all of this below the video, but this is just from a site called Y Charts, and they list some dates when there was an inverted yield curve. You can see a chart of it, how long it lasted, time from inversion to a recession, how long that took, number of days from inversion to recession. And then, of course, this one, now they've measured it as October 18th, and so they're probably looking at inversion. They're looking at different maturities. Oh yeah, that's right. They're looking at the 10-year versus the 3-month. So another way to look at it, and that gives you a slightly different date than if you compare the 10-year to the 2-year. Okay, concept is the same. And so there you go. And that's why right now cash is paying more than, say, an intermediate term bond fund like a Vanguard Total U.S. Market Bond Fund, ticker BND. It's the one that I own. It's an ETF. It's paying in the 4% yield right now. And that gets us back to this viewer's question. I wanted to go through that sort of background, though, so I think it's important to understand why cash is paying more right now than, say, an intermediate term bond fund. And that helps us understand, is this the new normal? Is this just how it's always going to be? If we knew that for the next 30 years, cash was going to pay more than, say, an intermediate term bond fund, I think, yeah, we'd move to cash. I would. But of course, what we know, at least based on history, is that yes, cash is paying more right now, and that's why it's so attractive, but it's not likely to stay that way. And we can actually look at history, and what I'll pull up, this comes from New York, NYU's School of Business. They record a truckload of data on returns going all the way back to 1928. This is a spreadsheet. I'll link to the website version of this below the video. And you can see each year they record in column C the 3-month Treasury bill, so we could think of that as cash. The U.S. Treasury bond, the 10-year, we could think of that as intermediate term bond, slightly, maybe edging towards longer term. And then BAA corporate, that is sort of the lowest corporate bond that would still be considered investment grade. And they've just recorded the performances for each of these every year. And then if we scroll all the way down, and I want to go to the geometric returns, and they break it up. This is between 1928 and 2023, and then they break it up into different, I'll call them economic regimes, 74 to 23 and 14 to 23. But the real key takeaway is that in each one of these, cash is lower than intermediate term treasuries, and they're in turn lower than the sort of, I'll say, borderline investment grade corporate bonds. Of course, with those bonds, you're taking on some credit risk. So our real focus are these two columns. And you can see long-term U.S. Treasuries, intermediate term, or in this case 10-year, have outperformed long-term cash. Now, since 2014, it's been very, very close. 127 to 146. If we look at the arithmetic average, it's 128 to 181. I tend to focus on the geometric compound annual growth rate. And so they are very close, but of course then we have to sort of ask, well, why is that? Well, interest rates were near zero. We know that. Now, of course, they're not now, and we've got the Fed trying to hammer down inflation. And here's the thing, eventually, if you believe that eventually the Fed will get their hands around inflation and then as a result begin to lower interest rates, in my view, that's going to be something that's going to favor the intermediate term bond strategy over cash. Now, I don't know when that will happen, but I do believe it will happen. They say in economics, predict what or when, but never both. I'm not an economist, but I'm going to predict what. I'm not going to predict when. Eventually, the Fed will get their arms around inflation, and I think we're already headed in that direction now. And I don't believe that the yield curve will stay inverted forever. Eventually, it will go back to a normal yield curve, which is how it behaves most of the time. And in that environment, I think long-term bonds intermediate term bonds will outperform cash. Now, I could try to time the market. I could say, well, let's put it in cash now because it's got a good yield, better than intermediate term bonds. And then I'll just kind of keep my eye on the news. And at some point, I don't know what will trigger it, but I guess at some point I'll just have an aha moment and get rid of the cash, get rid of the T-bills, let's say, and put it into BND or some other intermediate term bond fund. I don't personally believe that I am capable of doing that. If I'm being honest, I don't think most people are capable of doing that. And I find trying to go down that path gets most people, myself included, into a lot of trouble. So even though cash is paying more than intermediate term bonds right now, I haven't touched my long-term portfolio. The only T-bills I have are for cash I'm going to spend soon. But my long-term portfolio, the fixed income part of it, is still in intermediate term bonds and intermediate term tips. That's my approach. I haven't changed anything. Now, I don't know if that's convinced you or not to stay out of cash and keep your fixed income where it is, assuming it's in intermediate term safe bonds. But I do want to show you one other thing, and it has to do with the 4% rule. Because, Bill Bingen came up with that rule. He did the research back in '94. And he had a number of follow-on papers that he published. And in those papers, he addressed a lot of very interesting topics. One of which was, hey, what happens if we replace intermediate term treasuries, because that's what he used for fixed income in his analysis, with T-bills? He actually looked at this issue back in the 90s. In fact, I can show you the article. It's right here. And again, I'll leave a link to it below the video, but I can give you the long and short of it is he said, if you want to replace up to 10% of your fixed income with T-bills, that's okay, at least as it relates to the 4% rule. And I'll show you the relevant chart. It is, let's see, we'll go here. So this top line is where you just have intermediate term treasuries. You don't have any T-bills in your long-term portfolio. That's why it says 0%. And here's the 10%. And you can see when you get to a fair amount of stocks in your portfolio, that 10% line and the 0% line, boy, you can't even really tell them apart. And that was sort of his point. 10%, you want to convert 10% over to T-bills, probably not going to affect your safe withdrawal rate. But two things will. One, if you convert more than that, you see at 25% it starts to drop, and at 50% it drops a lot. The second thing would be if you, instead of replacing intermediate term bonds with some cash, if you replace part of your stock allocation with cash, that really affected the safe withdrawal rate in a negative way. So I wanted to point that out, something to think about as you're planning for retirement or perhaps in retirement. I'm still a big believer in coming up with a portfolio and sticking with it, so I've made no changes to my fixed income allocation. Obviously, you'll make whatever decision you think is best for you. I know that the 5+% on cash is very, very attractive, but at least in my mind, I would be very careful of trying to time the market on that and switching in and out of, say, intermediate term bonds to cash, hoping to get a fraction of 1% better yield, and that's assuming you time it perfectly. So that's my take. Of course, I'd love to hear your thoughts on it. Leave them in the comments below the video. And until next time, remember, the best thing money can buy is financial freedom.